new records for the S&P and the NASDAQ 100, Netflix shares popping. How do you see this trading day shaping up? What's your WEX word of the day?
Well, first of all, my word of the day is value, Frank. And I say value because we've closed at a third straight record high yesterday. Futures are up this morning. It looks like we could be gaining on the day. But, the big complaint that comes around with record highs is the fact that there may not be a lot of value. But these are unusual record highs in that we see a lot of value underneath the surface. And that value could be unearthed as we get the manufacturing and services data today.
All right, speaking of today, you're looking ahead to the manufacturing PMI. So we're going to show the estimates. Last month was 47.9. The estimate for this month's 47.2. That's technically contraction. If it comes in, at least at the estimate, what does that say to you?
Well, if it comes in at the estimate, Frank, the estimate's around 47. It wouldn't be shocking to me. I think manufacturing is still in a tough spot. But the thing that investors should focus on is the fact that manufacturing activity has stopped going down so quickly. We see it stabilizing and we're starting to see confidence pick back up again. So I wouldn't be shocked if we see the headline number come in well below that 50. That signals expansion. But at the same time, we need to watch the new orders in manufacturing. We need to listen to, the optimism we're hearing from the C-suite right now. People took notice when the Fed let us know last month that, rates could be coming down this year, and executives might have CapEx plans that they're leading on to. So I'd expect this manufacturing number not to stay in contraction for too long.
Okay, you're down in Charlotte. A lot of people call that the Wall Street of the South. Booming real estate market there. And your pick for us today is the real estate sector. You say it's trading at a discount from its 5-year PE. Right now trading at 38 times, 5-year PE 42 times. Is this simply a rate story? Is that what makes real estate so attractive?
Well, I think it's primarily a rate story. And yes, I'm in Charlotte where the real estate is booming, so I might have a bias here. But, I think as the market eyes rate cuts, as Treasury yields come down, I think real estate could be an interesting play. And it goes back to that value I was talking about, Frank. I mean, real estate is trading at a 38 PE, which is, quite well below its 42, forward PE average over the past 5 years. And it's one of those sectors that could be in focus as the market turns more toward rate cuts. We're really bullish on rate sensitive cyclicals right now. That includes banks, that includes consumer staples, but real estate, I think, could be one of the sectors that stands to benefit as we see economic data improve, which we believe will happen considering the uptick in confidence that we've seen lately.
Yeah, I think everybody thinks that the cuts are going to happen. That's pretty much the consensus, and the Fed's guided to that. But does it matter to you if it happens in March, or is a later cut just as good for your thesis when it comes to these rate-sensitive cyclical sectors?
I think the market is pretty much kind of led to the fact that we're going to get a cut sooner rather than later this year. If it happens in March or if it happens in May, it doesn't change our thesis too much because the outcome is the same, Frank. But I also think that the market eyeing several rate cuts isn't so crazy. The Fed has told us that they're eyeing rate cuts,
right,
that they're pleased with inflation's progress. But at the same time, you have to remember that the Fed's dual mandate is unemployment and inflation. The Fed's not looking at stock prices here. They want to get the seesaw in balance.